of a promissory note. So now let's talk about a note receivable. This is the first item we're going to look at on the balance sheet, and this is going to be an asset. You're going to see a note receivable on the asset side of the balance sheet. A note receivable is a written promise from a debtor to pay a specified amount of money to the creditor at a future date, basically redefining a promissory note. This is the written promise documented in a promissory note that one person is borrowing the money and another person is paying it back. And in this situation, since it's an asset, we are the lender. We are lending money to someone else, and this note receivable is an asset to us because we're expecting to collect this money in the future along with some interest. So let's take a look at a note receivable on our balance sheet, and let's just go through the motions of what that looks like and how it impacts the balance sheet and how it impacts the income statement. Here we have a couple, I'm going to hide the notes payable here. We have two examples of notes receivable. In this situation, we're working with Skynet Enterprises, and we have two employees that have bought shares from Skynet. We have Douglas Quaid and we have John Kimball. They bought shares of stock from Skynet Enterprises, but they did not have the money, the cash to buy those stock. So what Skynet Enterprises did is they issued a note receivable. Basically, they issued a promissory note to Douglas Quaid and John Kimball in exchange for the shares that they received. Now, Douglas Quaid and John Kimball will be paying back these notes receivable over the terms that we're going to go through very shortly, and that is how they're going to recuperate the cash or get the cash for giving these employees shares. First one on a line item here, the GL account 1800, which is our notes receivable. Douglas Quaid took out a note receivable on 1/1/2022 for $80,000. And the lender in this situation is Skynet Enterprises. That's why it's an asset on the balance sheet. We're expecting to collect that cash from these employees. And it's a 4-year promissory note. It's going to get paid back annually. You go to annual payments at a 3% interest rate. I actually wanted to clear these out. We're going to use the payment function to calculate the payment for these promissory notes, the annual payment, and the collateral in this situation of shares of Skynet. So if Douglas Quaid defaults, he does not pay back this loan, Skynet's going to take the shares back from him, and they're going to kill the loan, but Douglas Quaid does not have the shares. And this loan is due 4 years from the time it was issued, so the maturity date is 1/1/2026. So I want to show you the payment function because this is a real easy function in Excel where you can use to determine how much your monthly payment, quarterly payment, annual payment is going to be on a note. We're going to do equals PMT, paren. We're going to grab our interest rate. Now note, if you had a monthly payment, you would want to divide the interest rate by 12. In this situation, our N is going to be the number of times we're going to be making payments. If it was monthly, you would do 48, 4 times 12. But in this situation, it's an annual payment, so we're just going to do 4 years. And then I need to put in the present value. What is the present value of the loan? Now, in order for this to work properly, I need to put a negative in front of the promissory note. And then our next line item is what's the future value? Since we're expecting this loan to be fully paid off, it's 0. So I'm going to close this. Got my formula. Based upon the terms and using that payment function, I now know Douglas Quaid's annual payment, which is principal and interest, is $21,522.16 to pay off this loan in 4 years. And we'll prove that out in a second. I just want to run through the second note receivable that we have here for John Kimball. Same scenario, except this was issued 1/1/2023 for $130,000. Same lender, Skynet Enterprises. 4 years, annual payments. Interest rate went up a little bit, 3.5%. We'll skip over the payment real quick. Collateralized by the shares of Skynet, and the maturity date is 4 years from the date of issuance. So let's just run through the payment function real quick again so we can figure out what our payment is for this loan. So going through this again, we're going to grab our rate. It's a 4-year loan, 4 annual payments. Our present value is going to be negative what the principal lent was. And then our future value is 0 because it's going to be fully paid off. So we know what our annual payment is now using the payment function. Now we're going to take this next step because I want to know, specifically for the balance sheet and for the income statement, what is the balance on these promissory notes over their life, and what is the interest income that's going to be generated from these loans that I've issued for the shares of stock. So let's go over Douglas Quaid real quick. So his principal for those shares was $80,000. Year one, we've got 3% interest. So we're going to take that. I'm going to throw some dollar signs in there because we're going to end up dragging this down. In that first year, $80,000, Douglas Quaid's promissory note is going to generate $2,400 of interest income for Skynet Enterprises. Now I'm going to grab my payment that we calculated here. And then we're just going to go through the motions. So we issued $80,000. It generated interest for the entire year. We're going to make the assumption that Douglas is making these payments 1/1/23 of the following year. It's not happening during the year. So the ending balance for year one, $60,877.84. And we're just going to run this out for the life of the loan and just prove out the payment function. This is our note receivable amortization schedule. So let's do the same thing for John Kimball. We'll grab the $130,000. We'll calculate the interest. Let's grab the payment. Then we'll go through the motions. Drag that down. Drag this down. And we're going to take the ending balance, and then we can drag this down. Boom, 0. So I have my amortization schedule for these two note receivables. This is how they're going to be paid off over the 4-year term. So let's layer this now into the balance sheet and the income statement. We'll do the income statement first. So income statement, for this example, let's grab how much interest income generated related to these notes receivable in 2023. Grab that number, and we'll grab that number. So based upon the two notes receivable that we issued for the shares of stock that they purchased, we're going to generate $6,376 of interest income. Now let's do 2024. Same concept, except we're going to grab 2024. So in 2024, $4,706. You'll notice that it went down. And as these notes get paid off, since the principal is less, there's going to be less interest income, even though we're at the same interest rate. All right, let's head over to the balance sheet. So we're going to put our note receivable balances for these two notes as of 2023. And again, I'm making the assumption that he is making, both these gentlemen are going to be making their payments at the first of the year, the following year that they took out the loan. So in this scenario, I'm going to grab the principal balance, and I want to grab the interest that is accrued because he hasn't paid that back yet because he's paying it on the first of the following year. And I'm going to do the same thing with John for 2023. So you could break out the interest if you want, but I'm just combining the two. The note receivable is reflecting the principal owed, and it's also reflecting the accrued interest in this scenario. And since these are not due within 12 months, we're going to treat them as non-current assets. Now, if they were due, you could collect within 12 months, you would put those in current assets. So let's do 2024 as well. So 2024, I'm going to grab the principal, I'm going to grab the interest. For Douglas Quaid, I'm going to do the same thing for John Kimball. All right, that's my note receivable. That's including the principal that we're still going to collect, plus the interest that is accrued. So that is notes receivable. I will see you in the next video. Have a good rest of the day. Take care, and goodbye. Yeah.